So let's talk about the trade logic, okay? So you're forecasting prices to either go up or down. And the constraint on the forecasts, okay, because I need a certain amount of price movement to justify the costs of the derivative trades. It's not cheap, they're not free, okay? So I have to put up capital or I actually have to pay for these things. So I gotta get enough price movement to basically compensate me for the costs associated with buying these things or entering into these contracts. So the minimum movement in prices over 3 months is 8%. Okay, I like to see either 8% or 10%. At some point as you start to do more research, you are going to form your own forecast opinion, which is great, because now you are taking yourself from a student to a professional and then hopefully to an executive level. So, and then, you know, prices may move. I mean, how much did oil move or the stock market move in the last 3 months? I mean, we're not even 3 months into the year, but I think oil is down, what, like 10% already? So that's, oil movements up or down could easily be in the 8 to 10% range. Stocks are highly volatile right now, and so are bonds. So a 10% movement could be easy. I'd say if you're going to go beyond, do not go below 8. If you're going to go beyond 10% and maybe up to 15, you better have some supporting evidence to be able to document that. And if you go above 15%, you better have some really strong arguments and some really good data to support your projections. Okay. So this is basically the trade logic. Okay. We got prices falling. We got prices rising. When prices are falling, you're basically going short. When prices are rising, you're basically going long. Okay. If you're forecasting prices to go down, the trades exactly in this language, no deviation. And all of them need to be in capitalizations, okay? They all have to be capitalized, okay? No upper lowercase stuff, all uppercase except for the odds, okay? So if you're forecasting stock price indices or oil indices or gold indices or bond price indices or the value of US dollar currency indices, you are going to write forwards, okay? It's called writing forward contracts, but I'm just shortening the language. Write forwards. You are going to write futures. You are going to write calls on futures. You are going to buy puts on futures. And I'll get into the derivative definitions in a second. I'm just training you on the logic of the trades. That leads right into the memo. For the exchange traded funds, you are going to sell short. You are going to buy puts. You are going to write calls. The trades for the ETFs are exactly the same as the stocks in the same order. So you're going to sell short, buy puts, write calls, that's it. Exactly, okay, no deviation, all right? And there's no such thing as futures on ETFs or stocks. So it's only on the indices, okay? If you're projecting the prices to rise, stocks, oil, gold, bond prices, or the value of the dollar, you are going to buy forwards, buy futures, buy calls on futures, write puts on futures. For the ETFs and the stocks, you're going to buy on margin, buy calls, write puts. Same thing for the stocks. Buy a margin, buy calls, write puts. That's it. Okay? Very simple, very mechanistic, up or down. If it's down, you use these trades. If it's up, you use these. That's it. No deviation. Okay?